Canada, believe it or not. Despite all our political faux pas and missteps, our geology is creating fantastic cash flow for oil producers in Canada. For years, a lot of us investors went down to the United States with the Permian mania that happened and the Bakken and all that plays down there that really created incredible shareholder wealth for investors in shale oil. But a couple things happened on the way to the forum, as they say. What we found out in particular with the Permian, where just so much money got spent, was that the Permian gets gassy very, very quickly. The idea here with oil and gas is that in Canada, oil sits up on top. And it's a hydrocarbon that we say hasn't really been cooked that much. It hasn't had a lot of pressure and heat put on it over the eons. And so the deeper that these hydrocarbons get placed underground, the more they get cooked with heat and pressure, and it turns into natural gas. So that's why you see in the oil sands, it's just strip mining. It's like a quarry. The farther north you go, way up north, and so they don't actually drill any deep holes for the oil sands. They just literally carve it out of the ground. And as you get farther south, down through southern Alberta into the States, the geology just gets deeper and deeper. And what that means is that there's more and more natural gas. And so we all know what natural gas is worth. It's not even worth a bag of pucks, as we say in Canada. So what you're seeing is in the United States that even though we have $60 oil US, these companies are not making any money in the States. Almost none of them. In fact, a pretty good rule of thumb that you can take to the bank is any oil producer in the States, and one of my favorite lines is there's no such thing as an oil producer, as a US oil producer. That's a misnomer, doesn't exist. They're all natural gas producers, every single one of them, except for maybe 4. There's literally probably, I'd be surprised that there's even 10 producers in the entire United States that are more than 60% oil. They're almost all natural gas producers that have a certain amount of oil. And like I say, natural gas is worth nothing. So as a general rule of thumb, when you see that the oil price is $60 a barrel, that means their average realized price that they get when they combine all their gas, their oil, their propane, their ethane, all the different, what we call natural gas liquids, they're getting about half the price of WTI. So if WTI that day is $60, you can pretty much take as a pretty accurate rule of thumb that every single American producer is getting about $30 for their realized price. Maybe a little more, let's say around 33. So in Canada, it's a totally different story. Our geology is quite shallow. We don't drill down 10, 13,000 feet or even 8,000 feet. We drill down somewhere more like 2 to 4 or 5,000 feet, and we get almost all oil. So what that means is that for the first time in years, Canadian oil producers are dramatically outperforming American stocks. And so we have great cash cows of companies up here. Certainly all the majors that whether they're, and the oil sands producers, so you're talking about companies like CNQ, Canadian Natural Resources, Cenovus, CVE, these companies, and MEG Energy, MEG, these companies are unbelievable cash cows. Not just positive cash flow, but free cash flow. So that would be lots of money coming in above and beyond their commitments for drilling and G&A and dividends. Huge free cash flow. So literally, I think you would be hard-pressed to find any time in history when Canadian energy was this profitable. Even back in 2008, when oil was much higher, their cost structures were much, much higher. So if they were more profitable back then, it wouldn't be by very much. And the opportunity for investors, and of course, if anybody who follows Eric Nuttall on BNN, he's been banging this drum for over a year, our valuations on these cash cows have never been lower. You've got record high cash flow and record low valuations. These companies back in 2014, before the Saudis pulled the rug out from under everybody, like the good ones were trading 9 to 11 times cash flow and trading at 2 times NAV. and they were able to use their equity to do more deals and get bigger land positions and drill more wells. But now everybody is basically 2.5 to 4 times cash flow, despite being crazy profitable. 2.5 to 4 times. Now, I don't know how that's really going to change over time, because there's a couple things I'd tell you. Is that the institutional community, certainly the international institutional community, doesn't want to play in Canada anymore. And that's mostly politics, but also the whole shale era has kind of come to a close. We're going to keep continuing to produce shale, because we have to. There's continual rising demand for oil, but the institutional community is just done with the treadmill of production, where these wells go down 80%, 60% in year one, pay out after 18 months, but might take 5 years to pay out again. And the unbelievable amount of capital they've got to put in to keep the treadmill going just takes forever. And so they don't have any interest in that play anymore. So I'm not here saying, oh, Canada rocks, so therefore let's go out and buy all these companies. That's not what I'm saying, but I'm just saying that now that there's been a full reset on valuation, there's value once again in the Canadian oil patch. And if you're looking at energy, you are way better off up here than you are down there. So, and certainly if I was an American, we've generally been a petrocurrency, so if oil keeps going up, we should see the loonie also pick up, which it did quite a bit last year. It was up 3%. We were the best performing currency against the US last year of all the G7. What we're doing here in Canada is using all our free cash flow to pay down debt, because all the oil sands guys, they still have quite a bit of debt. MEG and CVE have big debt, so they're using all that debt to pay down that debt. And so, but that's still a good delevering story. If your enterprise value is market cap plus debt and you're getting rid of debt, that means you're increasing your equity value. But so I think buying the large Canadian oil stocks is kind of a no-brainer right now. There's almost no downside. We're seeing, and I'm going to explain that with the Permian down in the States really setting the tone for oil production in the States, there's quite a big theory that that's going to peak and perhaps even roll over this year. And if that happens, then WTI prices should quite dramatically outperform Brent. So the $7 or $8 gap has a shot at coming much, much closer this year. I'm actually buying Canadian nat gas companies this year as well for the first time in a very long time. And again, the whole idea here is I've got a few slides that'll explain to you why I don't think nat gas is going to the moon this year, but I just think that the Canadian nat gas is going to have a brand new floor price under it because of increased oil sands production, and that they use the nat gas and the condensate to dilute that oil to go into the pipeline. So we have been the ugly stepchild of the nat gas market with the lowest prices in North America for the last few years. And while that's still probably going to be the case, we're going to be much closer. We're going to be much closer to everybody else. And the Canadian producers over the last few years have had no capital available to them to grow. So they've had to learn how to cut costs, do better technology, tweak every little thing they can to increase economics. So they are as lean and mean as possible now. And they're producing 50% of their production often is nat gas, and it accounts for only 5% of their revenue. So all of a sudden, if they're going to get a 3-4-fold jump in nat gas prices, and again, you're going to find this hard to believe, but nat gas prices in Canada have gone negative every year in the summer for the last couple of years. So that's where the producers are actually paying their customers to take their gas away. And so that generally only happens in the summer, but actually it's even happened in the Permian now. So I just think just with a couple of changes that I'll explain here, that's not going to be the case anymore. We're going to see much steadier pricing, not high prices, but steadier prices for nat gas in Canada in 2020. So again, your big increase in oil production around the world this year is going to be internationally, not in shale. Shale is going to have quite a small jump in production. We certainly have the ability here in Canada, if politics allowed us, we could increase production 1 million barrels a day very quickly, but that's not going to happen. So we are going to see higher production in both North America and around the world, but much higher relative production internationally. And you also have North American producers, not just U.S., but North American producers growing within cash flow, so their growth is going to be quite muted compared to prior years. And as I say, if it works so that we get a rollover in Permian production, then we really could see quite a nice jump in WTI prices and profitability for the industry. Okay, so here's a slide that shows that U.S. production growth peaked here late last year, and it's forecast to go down, down, down. And this is just one person's view. There are a lot of people calling for the Permian to stop growing as early as April and May this year. So if that really does happen, that's going to be a boon for WTI prices. And the one thing I want to stress is that oil prices don't have to go up very much for these oil stocks to really come back, because they're basically at 2.5 to 4 times cash flow, priced a little bit better than bankruptcy. So just the sentiment is going to change and take these things back up to 5, 6 times cash flow and give them a bit of a lift. So what's been happening here? So this is a chart that needs some explaining. So the red line is the rig count in the United States. So how many rigs are drilling for oil? And that's been coming down now for quite a while. The white line is the price of oil. And the yellow line is the break-even level for Permian producers. They are the barrels that set the price now. What happens in the Permian will decide North American oil prices. So what we're seeing here is that the industry is now getting very close to doing their break-even, so that you can see how wildly profitable they were in 2018 when prices just went up right till September, and they were cash cows, and so they just kept bringing on more barrels and spending more money because they were major cash cows. But now, for the last year, the price of oil has hovered right around the break-even price for shale in the Permian, and you're seeing the rig count still come down. That just says they're not making money at this price. They're not. So you're still seeing drill rigs get retired, even with prices up here at $59. So we put together this price matrix to kind of make it a little bit clearer. So the green means that the price of oil and gas, the realized price per barrel, is high enough that it will increase the rig count. Red means that it'll completely decrease the rig count, and orange and yellow is kind of like a little bit decrease. And that's kind of where we are right now. Right now, with gas around $2 and oil just around 57, 58, we're seeing that we're in the yellow zone. So that should still mean a decrease in rig count, which should ultimately put us back into the green at some point. But it does mean that we're probably not going to see any huge increase in prices, because there's just so many rigs that can come on super quick if prices really get out of hand. So right now, yellow to me would be a cautiously bullish, cautiously optimistic view on oil stocks and oil prices. So this is a bit of a segue. I would just say that flaring in the Permian is the reason we're here. So the U.S. has a law that says, and Canada does too, that you're only allowed to flare so much your natural gas. Methane's a major greenhouse gas, GHG. And so if the U.S. enforced their flaring laws, Permian production would have to get rolled back dramatically. The Permian flares almost 1 billion cubic feet a day. What they release into the atmosphere could heat every home in Texas every day. So when I see the environmentalists up here talking about one pipeline, like there are thousands of miles of pipeline got built in the U.S. last year. In fact, our pipeline stocks like Enbridge and TransCanada, TC Energy, are doing great because they have a monopoly. No, there's no new pipe getting built. Down there, pipeline stocks are in the tank because these guys have to lower their prices so much. They've overbuilt the whole sector. And the green lobby up here, after what's happening in Texas every day is worse than what's happening up here in Canada in a year. So it just goes to show you how they don't really care about the environment. They're just politically motivated where they think they can get the most action, and we're the suckers, so we put up with them. And not that they're saying everything's bad, but there's much worse things going on in the world right next door that should have more attention. And that just gives you the idea of how bad flaring of natural gas is in Texas. So oil, conclusion, if the Permian rolls over, WTI prices are going higher, and all these oil stocks should do really well. But if the Permian does roll over, buy Canadian stocks, not American stocks. And again, there's no such thing as an American oil stock. But now, nat gas, I'm going to have to run through this pretty quick. You can just see how the growth in U.S. production, it's unbelievable. Literally 10 counties in Pennsylvania and West Virginia have changed the world for nat gas for almost a decade, and they continue to do that. And then came the Permian with all its associated gas. It's quite remarkable. So Raymond James has this theory, however, that Canadian nat gas is actually going to be the place to be. And so because of a legal issue, the way they stored gas in Canada changed for about 3 years. And I'm not going to get into it because it's pretty esoteric, but they just changed it back to you can just store gas whenever you want in Canada now. And they did that in September. But the result is that blue line, we have record low storage of nat gas right now. And we've seen one of the coldest winters in history in Western Canada. And we've also seen declining production. So you've got record low inventories, you've got production falling off a cliff. So if you've got lower supply, and this third slide here, the blue line is the pipeline capacity for nat gas in Canada. And you can see that it doesn't take very long for nat gas production to catch up to the blue line increments when they move up, except right now. You're not seeing the production increase meet the new capacity that's available, which tells us that there just isn't the production to fill it. So if we're seeing much less supply on constant demand, that should mean higher prices. And like I say, these companies don't need much higher prices to see huge increases in cash flow. When you're paying your customers to take your gas through the summer, and all of a sudden you're going to get $1 to $2 an MCF, that's a massive increase. And we have seen some of that get reflected in the stocks. Some of the leading Montney stocks in Canada are up, 30 to 50% since December. So again, the whole thesis here that Raymond James has come up with is that we're seeing, much like oil, where we're seeing record low valuations just at a time when the market's starting to turn bullish. So that should be really positive for stocks for nat gas in Canada, because they're basically priced at bankruptcy levels. And just last year, the big year was actually renewables. The solar inverter stocks. This is Brookfield, Bruce Flatt's team out of Toronto, that's recognized as one of the best companies in the world. Nothing's changed with their business. The valuation on these stocks just all took off last year because the market decided fossil fuel bad, renewables good, and it's the same company it was a year ago. But that's just what happened, and I would expect the same thing to happen. So I'm going to leave you with 3 stocks here to look at this year. So these are, this is a mining show, so everyone's a gambler. So I picked some low cap stocks to have a look at. Altura, ATUs at 32 cents, great team, doesn't need to finance to grow. New oil play in Alberta, just outside Calgary. If it works, the stock should do very well this year. Rico, Reconnaissance Energy Africa, they've got 6.3 million acres, an entire shale play in Namibia. If that well hits, it's going to go a lot higher. If it doesn't, it won't. And as full disclosure, they're a client of mine. Green Lane, GRN, this is a renewable natural gas, RNG, that trades for $30 an MCF. They've just announced one new contract. I think there's a lot more coming. It's the old Westport team. And again, they're moving ahead. They're doing really well. The stock's gone from 20 to 50 cents, and I think there's good things ahead. So that's my speech, guys. God bless you for showing up. I'll be outside for 15 minutes before I got to take off. Thanks for listening.